Let's do Ask Annex in the studio. Fred Coleman, CFP and a wealth manager at Annex Wealth Management. Welcome.
Danny.
And let's say hello to Matt Morzy, investment team manager, also CFP.
Hey, Danny.
Here we go. The company I work for will match 7% into a Roth IRA or pre-tax 401k. Which would be better?
Great question, and this is one of the most common questions that we get. And although, usually it's just a click of a button to change that, it's a very important decision that you'll face. It comes down to tax planning. It's something we help our clients with all the time. When you put your money into a pre-tax account, you get the tax deduction, and you're able to pull that money out at a later point with it growing tax deferred, and you just have to pay taxes on it. So that's a huge benefit. It also allows you to invest a little bit more because you'll have a little bit more on your check from those pre-tax savings. So essentially, you get to choose when you want to pay taxes on it. You're deferring that now, and then at any later point, you say, hey, this is a good time for me to pay tax on that, up until you're 70 when you're forced to take it out, or in your 70s. With Roth, if you follow the rules, the benefit to that is you never pay taxes again on it. Generally speaking, Roth's better for younger individuals, those who are paying less than 20% in their taxes. And if you expect your wages and your taxes to increase over time, now, if you're paying 30 to 40% in taxes, when we talk about both state as well as federal taxes, then you're paying 30 to 40 cents on every dollar that you put into the Roth, and that's quite expensive. So in that case, pre-tax would likely be the best option. So it really depends on your individual circumstance, but that 7% match is a great number.
Yeah, I think that's a great opportunity for that person to come on in and sit down with one of our wealth managers here and let our financial planning team create, a custom financial plan for them where they can put those numbers in, put in both in traditional and into the Roth, and see where they end up later on in life and which one might be a better option for them.
Next up on Ask Annex, been saving for our future grandchildren's college fund. In 2022, we started putting money into an I-bond and now have more money to contribute to this college fund. But I'm feeling I-bonds are not the best bet anymore. I don't want to lock money into a 529, so looking for other options. With the upcoming contribution, we will have $40,000 set aside so far.
Great. That's great saving. And when it comes to the investment type, it really depends on your time horizon. If it is a while before your grandchildren are going to go to college, then more of a stock portfolio is probably going to be better because they're going to have more time to recover if there is a downturn or, inevitably there's going to be bear markets over time. I would only use I-bonds or other short-term instruments if the time horizon is within the next few years. There are also other options outside of the 529. So the 529, it does give you those tax benefits, but there still are other good options such as UTMA accounts because you can use almost any type of investment that you want in that account. And once your kid reaches the age of majority, the thing to keep in mind about that, they can use the funds for whatever they want and you have no control over it. But they can use it for college if they want, or you can open up a brokerage account for yourself and build that into your financial plan. Now, you will have to pay the taxes on that, but it does provide a little bit more flexibility if you don't want to open that 529.
Yeah, I think you're hitting a couple of really good points there. One is what kind of control do you want over the money versus how much control do you want to give that future grandchild? In a custodial account, like you said, eventually it's going to become their money and they're fully in charge of it. If you have it in a taxable brokerage account yourself, it's fully your money. You're paying the taxes on it again because it's yours, but ultimately you decide when they get it, how much they get, what the purpose of that's for, and you get to maintain that control. And then on the investing side of it, when I hear future grandchildren's college fund, I'm thinking that child's not alive yet, and you're going to have a long time horizon because you got 18 years plus, whatever, until that child's even born before you get to that spot. And how many grandchildren is that going to be? So you really are going to be looking at taking more risk, especially now, because that time horizon is so far from now. So something like an I-bond, although they gave awesome interest rates when inflation was high, that's not something that's going to be a long-term solution for this type of situation. So you do definitely want to look at the stock market as an option there.
You'd also like to sit with them and say, what is it about a 529 that you don't like? But that's for a deeper conversation.
Oh, for sure.
Yep. Last question on Ask Annex. With inflation still above the Fed's target of 2%, should I prioritize dividend-paying stocks or focus on long-term growth potential in broader market investments, even if they might be more volatile in the short term?
Yeah, I think when you're looking at the, in terms of what this question is asking is how should your portfolio be allocated, you really want to balance those two things out. So whenever you're constructing a portfolio, you want to balance large stocks versus small stocks, U.S. versus international, growth versus value. These are all things that need to be part of a balanced portfolio because although maybe the Fed's inflation's coming back down and dividend might seem a little bit more attractive because you might be able to get above what those short-term interest rates might be, you are giving up some of that growth there too. So you really want to balance all of that out. And I would try to stay away from trying to time any of those things. Now, you can make maybe smaller changes within that overall portfolio based on what's happening in the market. But I would really want to try to combine all of that because depending on what the time horizon is and, that we don't know from this question, you don't want to give up that long-term growth just to get a little bit higher yield today.
Matt Morzy, Investment Team Manager and a CFP. Thanks.
Thank you.
Fred Coleman, CFP and a Wealth Manager at Annex Wealth Management. Thanks.
Thank you.